Hi, welcome back to Joe Blogs. In today's episode, I want to provide you with an update as to what's happening in the Chinese economy. The Chinese economy has been on a roller coaster ride in 2023. At the start of this year, following the removal of the COVID-19 restrictions in December 2022, there were high expectations, and a lot of economists were saying that the Chinese economy could deliver 6.5% to 7% growth, which would have really fueled the global economy. However, in the second half of 2023, things have not been going to plan, and expectations now are that China may hit 5% growth, so significantly less than everybody thought at the start of this year. However, over the course of the last few months, we've started to see cracks appearing in the economy, despite the fact that the Chinese authorities have introduced a variety of different measures to try to get the economy going again. Now, this video is being made on the 31st of October, so we don't have the official data as yet for the month of October. However, what's been released today is the official Purchasing Managers Index. And the Purchasing Managers Index is a really important metric because this is a survey that's taken amongst all of the different purchasing managers in China. And it tells us whether the companies that they work for are expanding or contracting. And the figures that have just been released for October show that overall Chinese companies are now contracting. And this has raised major concerns about whether or not China will be able to hit its 5% revised target for 2023. And if it doesn't, then that's going to have major ramifications for the Chinese economy, but also it'll have a knock-on impact to the global economy because China is the second biggest economy in the world. And so if China is slowing down, that tells us that the rest of the world is going to slow down as well. So unfortunately, nobody's going to be immune from what's happening in China. So in today's video, we'll have a look at the latest data that's come out from the purchasing managers. We'll then talk about GDP growth and have a look at what's been happening in China over the last couple of years and have a look at where we are right now and what China needs to do to hit its target for 2023. We'll then have a look at the latest available data on exports and imports. We'll talk about what's happening with inflation because China is sitting on the verge of deflation. Prices are actually going down, which may sound ideal if you're a consumer, but certainly isn't what you want if you're a company in China because it means that you can't pass on any cost increases and you can't increase wages. We'll then have a look at what's happening with the Chinese Yuan, and then finally today I'll wrap up with my summary. So what I think is likely to happen in China during the rest of 2023 and what the implications of that are for the Chinese economy and also the global economy. But before we get started, I'd like to say once again, thank you so much to everyone that's bought me a coffee or sent me a YouTube super thanks. Really appreciate that. It does mean a lot to me. And if you'd like to support the channel, please have a look below where you'll find links to my Patreon channel where you can get early access to videos and also avoid adverts. But as well as Patreon, you'll also find links to buymeacoffee.com as well as YouTube super thanks and membership scheme. China's manufacturing activity unexpectedly contracted in October, underlying the daunting task facing policymakers as they try to revitalise economic growth heading into the end of the year and 2024 amid multiple challenges at home and abroad. This chart shows the Purchasing Managers Index for both manufacturing businesses and non-manufacturing businesses in China, dating back to the start of 2021. Now, if you follow the channel, you'll know that we've discussed the Purchasing Managers Index a number of times. This is basically a survey that's completed every single month by the purchasing managers from thousands of different companies. And the reason that the purchasing managers are important is that they're planning ahead. They're buying in all of the raw materials that companies need to be able to produce their products. And the key figure when looking at the Purchasing Managers Index is 50. A score above 50 indicates that a company is expanding, it's growing, and a score below 50 indicates that a company is contracting. And if we look at the red line on this chart, which shows the Manufacturing Purchasing Managers Index, which is the critical index from China's point of view, as manufacturing is the basis of the Chinese economy, you can see that the PMI for October was 49.5, so below the critical 50 level, and therefore indicates that Chinese companies are now contracting. And this result was actually a shock to the markets, which were expecting a score above 50. And if we look at the movement of this chart from the beginning of 2021, you can see why there are major concerns over the Chinese economy. In the first half of 2021, the index was above 50 as the world came out of the COVID lockdowns and demand for manufactured goods increased. However, the index fell back below 50 in the second half of 2021. It very briefly rose above at the start of 2022, but following Russia's invasion of Ukraine, which started in February 22, there was a significant drop in the PMI. It remained below the critical 50 level for the rest of 2022, and in December we saw the biggest fall in the index as major concerns started to rise about the outlook for 2023 for China. The Chinese authorities then removed all of the COVID-19 restrictions, which were seen as holding the economy back, and in February of this year the index rose to its highest level for 3 years. However, that optimism was short-lived, and by April the index was back down below 50, and it remained in negative territory until August. In September the index did rise above 50, and optimism started to increase that the outlook for the rest of this year was positive for China. However, the latest data has dented that optimism, and there are now concerns about whether or not China will be able to achieve its targeted 5% growth for 2023. If we now have a quick look at what's been happening with the non-manufacturing PMI, which is not as critical as the manufacturing PMI, but still gives us a strong indication as to what's happening in the Chinese economy. You can see that the movements in the non-purchasing managers index follows a similar pattern to the manufacturing PMI. However, the movements are far more extreme, and you can see that the peaks and troughs are far higher. And if we focus in specifically on what's been happening in 2023, you can see that the recovery in the non-manufacturing PMI in February, March and April was significantly greater than it was for manufacturing. However, there's been a significant fall in that recovery, and the index is now only just above the critical 50 level. In terms of the outlook for the rest of 2023 and 2024, analysts are now saying that more policy support may be needed to ensure that the economy hits the annual GDP target of 5%. A raft of measures including interest rate cuts, increased cash injections and more aggressive fiscal stimulus have been introduced since June, following the rapid loss of economic momentum that was given by the removal of the COVID-19 restrictions. However, real estate, which accounts for more than 25% of China's economic output, has shown few signs of turning the decisive corner. The latest data shows that China's home prices fell for a third straight month in September, a traditionally peak home buying period, while property sales and investment extended double-digit declines. High youth unemployment, elevated debt levels, and a weakened yuan are also causing problems for China. This chart shows the year-on-year movement in China's gross domestic product, dating back to the start of 2021. The scale on the right-hand side of this chart goes from 0% growth at the bottom to 20% positive growth at the top, and each of these bar charts shows the annual GDP growth for the previous 4 quarters. And I think the obvious initial takeaway here is that China's growth has been all over the place in the last 3 years. The Chinese economy hasn't been chugging along at a steady growth rate, but rather it's been up and down. Now, if we start off by looking at 2021, this shows that the growth in GDP for the 12 months ending Q1 2021 was an absolutely incredible 18.7%, which seems amazing. However, in order to understand that figure, we need to expand the scale of the chart. And you can see that at the start of 2020, so the first quarter of the previous year, there was a huge fall in the annual GDP growth rate. And that was obviously as a result of the fact that the world went into lockdown because of the COVID-19 pandemic. And you can see that as a result of the fact that the whole world had stopped buying things, China experienced a fall in its GDP of around 7% in the first quarter. And therefore the data for the 12 months ending Q1 2021 is being compared against that very low figure, and that explains why there's such a massive percentage increase. The impact of the sharp fall in 2020 then works its way out over the course of the next 3 quarters, and the 12-month GDP growth for 2021 for China was 4.3%. If we now have a look at the 4 quarters for 2022, you can start to see the problems that have been occurring in the Chinese economy. In the first quarter, the 12-month growth figure for GDP was 4.8%. However, it then crashed to 0.4%, bounced back to 3.9% in Q3, and the full year figure for 2022 came in at 2.9%, which is obviously significantly lower than 4.2% for the previous year. And if we quickly jump back to the 10-year chart, you can see that the result for 2022 was China's worst, excluding the exceptional COVID-19 period. If we now look at what's happened in the first 3 quarters of 2023, the 12-month rolling GDP figure was 4.5% in Q1. It then rose to 6.3% for Q2, And at that point, there was a lot of hope that China was going to achieve somewhere between 6.5% and 7% growth. However, that expectation has now fallen significantly, and the 12-month rolling GDP figure, as at the end of Q3, is 4.9%. Now, the expectations for 2023 have now been lowered to 5%. However, as the 12-month rolling figure is sitting at 4.9%, China needs to have a good final quarter, and as we've talked about in today's video, the PMI index tells us that companies in China are currently contracting, and there are rising concerns that China won't be able to hit that 5% target for this year. So in order to get a better understanding as to what's happening in terms of trade, let's have a look at the latest data for exports. This chart shows the year-on-year movement in China's exports over the course of the last 12 months. And this really highlights the problems that the Chinese economy has been facing. Because as you can see, in 10 out of the last 12 months, exports have fallen year on year. And manufacturing and exports are the main driver of the Chinese economy. That's what China's built its economy on. So that represents a major problem when you've got year on year falling exports. And if we look at the latest data for September 23, you can see that year on year exports are down by 6.2%. And just to remind you, the expectation for the Chinese economy is 5% growth for 2023. So a year-on-year fall of 6.2% represents a significant shortfall against that 5% growth target. Now, when we're looking at a graph like this, one of the ways of understanding what's happening in the economy is to look at the trends, what's happening month on month. So if we go back and look at the situation at the end of 2022, you can see that in October, exports fell by 0.3%, so a very small amount. However, in November, December and January, exports were down by 9%, 10% and 10.5% respectively, which basically represents a crash in the economy. And the reason that exports were falling so dramatically at that time was that China was still operating a zero-tolerance policy with regards to the COVID-19 pandemic, even though it was 3 years on from the initial cases, and the rest of the world had actually moved away from having draconian lockdowns. The Chinese authorities then decided to change all of its policies and removed all of the restrictions. And as a result of that, there was a significant improvement in exports. And in March, exports were up by 14.8% year on year. And at that point, the expectations were that the Chinese economy was going to have a very strong 2023. This was the bounce back that everybody had been waiting for. However, unfortunately, at the same time as that was happening, the rest of the world started to go into slowdown. And in April, the year-on-year increase in exports reduced to 7.3%. In May, China returned back to negative territory when exports fell by 7.1% year-on-year. The reduction in exports accelerated to 12.4% in June. And in July, exports fell by 14.3% year-on-year, which was a nightmare for the Chinese authorities. They then introduced a variety of policies to try to stimulate the economy. And over the course of the last couple of months, we've seen a reduction in the fall in exports to 8.8% in August and 6.2% in September. So if we're looking at the trend over the course of the last couple of months, there has actually been an improvement. We're seeing it moving in the right direction. However, China is still experiencing a year-on-year fall in exports and needs to get back into the black as quickly as possible if it's going to have a chance of hitting that 5% growth target for this year. This chart shows the year-on-year movement in imports for China over the course of the last 12 months. And the reason that imports are very important when we're looking at the Chinese economy is that China imports lots of raw materials and fuels, which it then uses in its manufacturing processes so that it can produce goods to export. So the level of imports gives us a good indicator as to what's happening in China, whether or not the economy is gearing up. Companies are buying in more raw materials and fuel so that they can boost their future exports. And as you can see from this data, in 11 out of the last 12 months, the year-on-year movement in imports has been negative. And interestingly, the year-on-year fall in imports in September was 6.2%, which is exactly the same as the fall in exports that we just talked about. And if we look at the trend as to what's been happening over the last 12 months, you can see that in the first 4 months of the year, there was a significant fall in the level of imports. And in January 23, imports were down by 21%. Which when you think about growth of 5% for the economy is miles away from where China wanted it to be. There was a minor bounce back in February when imports actually increased by 4.2%. However, in the 7 months since, imports have fallen in every single month. and imports hit another low point in July when they were down by 12.3%. Now, in exactly the same way as we discussed for exports, the trend over the last 2 months is a slight improvement. However, the fact that imports are still down year on year in September tells us that companies have not geared up. There is not a huge push for the end of this year, and so it's unlikely that we will see a huge upswing in terms of the level of exports in October, November and December. This chart shows the movement in the official rate of inflation in China over the course of the last 12 months. Now, we've spoken a lot about inflation for lots of different countries over the last 18 months, and the majority of those discussions have been focusing in on high inflation, runaway prices being pushed up by the high cost of oil and gas and food and lots of other commodities. However, what we're seeing in China is the opposite of that story. We are seeing a story of deflation, and deflation can be just as damaging to an economy as inflation. Now, the target rate of inflation in China, along with lots of other countries, is set at around 2%. And you can see that in October, November, December and January, inflation was at or around that level. However, as both the Chinese economy and the global economy started to slow down, inflation started to fall in China, dropping to 1% in February, 0.7% in March, 0.1% in April, 0.2% in May, 0% in June. It then fell to minus 0.3% in July, increased by 0.1% in August, and in September inflation is officially 0% in China. So that means that prices today are exactly the same as they were this time last year. Now, if you're a consumer, if you're buying things, then you may think that 0% inflation is a good thing. You don't want to pay any more for any of your goods, and that means that you'll have some more money in your pocket. But if you're a producer, if you're a company that's manufacturing things, 0% inflation represents a big problem. Firstly, it means that you can't pass on any increase in prices. So if you're having to pay higher prices for oil and your raw materials and any other of your input costs, then you just have to absorb those price increases because you're not able to pass them on in your end price. But also in terms of dealing with your staff, you won't be in a position to be able to make pay increases because you're not receiving any more for any of the goods that you're selling. So this does represent a serious issue for Chinese manufacturers. And of course, the Chinese economy is built on manufacturing. The majority of companies are making things. So 0% inflation or deflation is a major risk to the Chinese economy. And if we expand the chart out to show the position over the last 10 years, you can see that China has only been in this position once before, which was during the COVID-19 pandemic, when all bets were off. Everything was out of the window in terms of the global economy. The whole world had closed down, and so that doesn't really represent a normalized period. So this is the first time that China has experienced a problem with deflation. And the issue that it has is that it's very difficult to shake off. Over the course of the last 20 years, the Japanese economy has experienced long periods of deflation, and that's had seriously negative impacts on their overall performance. As the Chinese economy is so focused on exports, the value of the Chinese yuan is really important to the strength of the Chinese economy. And this chart shows the movement between the US dollar and the Chinese yuan, and what this shows is that 6 months ago, $1 US was trading for around 6.9 Chinese yuan. Today, it's trading for around 7.3, which represents a fall in the value of the yuan of around 6% over that period. Now, the generally accepted principle in economics is that the strength of a currency is often linked to the strength of an economy. So if your economy is doing well, you would expect your currency to be performing well, and vice versa. And the fall in the value of the yuan over the course of the last 6 months tells us that the Chinese economy has been struggling during that period. And it also goes some way to explaining what's happening with inflation. When Chinese companies are striking deals with overseas businesses to sell their products, there will be a contract that's put in place that will determine exactly how much that overseas business is going to pay for those goods. So if we walk through a quick example as to how that might work, if you're a business that's based in America and you wanted to agree a deal to import a product that was going to take 6 months to deliver, you may have signed a contract with a Chinese company whereby you were happy to pay $1 for that product. And 6 months ago, $1 would have equated to 6.9 yuan. So you put a contract in place to pay 6.9 yuan for the delivery of that product. If we assume that that product takes 6 months to manufacture and deliver to the USA, so is being delivered now, the Chinese company has fulfilled its contract and will be paid 6.9 yuan for that product. However, because the exchange rate has weakened significantly, that $1 product today would be selling for 7.3 yuan, which means that the Chinese manufacturers basically lost out to the value of 0.4 yuan. And this partly explains why prices are falling in China at the moment. It's partly down to the slowdown in the global economy, so demand has fallen. And in order to keep its volumes up, China is lowering its prices. But at the same time, the value of the yuan is also falling, which means that in real terms, Chinese businesses that have been agreeing contracts over the course of the last 6 months are receiving less Chinese yuan today than they would be if they were striking those deals right now. So what's the summary and conclusion today? Well, I wanted to post this video firstly to give you the very latest data that's hot off the presses. And the Purchasing Managers Index is the first indicator that we get every single month to tell us whether the Chinese economy is going up or going down. And what we've seen from today's data is that the Purchasing Managers Index is now back below that critical 50 level, which tells us that China is contracting again. And that is obviously bad news in terms of the outlook for the rest of 2023. As we discussed right at the start of today's video, China has been on a roller coaster ride this year. 1 month everybody's feeling very negative and that things are going badly in China, and then all of a sudden the mainstream press start talking about an improvement in performance or a trend, and that things are now looking up from the Chinese perspective. But if we take a step back and look at what's happening overall in China, the latest data isn't really a major surprise, because China is manufacturing products which is selling to the rest of the world. And when you look at what's happening in the global economy, there's a major slowdown happening. So the buyers of China's products are not growing at the same rate as they were this time last year. And of course, that means that there will be a reduction in demand. And as we saw from the data, exports continue to be down, as do imports. And that import figure is really important because it tells us that China isn't buying as much in terms of raw materials, and therefore it's not loading up the pipeline so that we're going to see explosive growth in terms of sales. So I don't think it's really a major surprise that the Purchasing Managers Index has fallen back below 50. And then if we take a further step back and think about what's happening in the property sector in China, because the property sector accounts for around 25 to 30% of GDP, and the property sector is on its knees at the moment. Over the last 20 years, that sector was fueled by debt. All of the major property developers were able to access massive amounts of debt, which they were able to use to grow their businesses. These companies literally could not build apartments quick enough to satisfy the demand. But unfortunately, as soon as the rug was pulled in terms of the availability of that debt, these companies found themselves in financial difficulty. And the vast majority of these businesses are now in default on all of that debt, and therefore don't have the cash to be able to build out all of the apartments that they've pre-sold to Chinese consumers. So consumer confidence has now been completely eradicated in terms of the property market. Nobody wants to buy property anymore, and we're now seeing falling prices, falling sales, and a lot of these companies are on the verge of liquidation. And Evergrande, which has the most amount of debt out of any country in the world, not just in China, around $340 billion worth of debt, recently announced that it wasn't able to complete on its restructuring proposals because it's not in a position to be able to issue any new bonds. And a court date has now been set for the beginning of December for Evergrande to present its final plan. And if it doesn't present that plan, then it will go into liquidation. So there are major problems in a sector which accounts for around a third of the Chinese economy. So it's not really an enormous surprise that the Chinese economy is not doing particularly well right now. So the big question is, will China be able to hit its 5% target for 2023? Well, as we saw from the data, the 12-month GDP to the end of Q3 for China was 4.9%. So to hit that 5% target, China needs to have a strong final quarter. And what we're seeing from the October figures is that it hasn't had a good start to that final quarter. So it needs to have a really good November and December in order to get where it wants to be. And if we now take a look out the window and look at what's going on around the rest of the world, Russia's invasion of Ukraine is obviously still ongoing, but we've now got the war that started in the Middle East in Israel, and that's causing major concern from a geopolitical perspective because there is a risk that other parties could be drawn into that. Iran are long-time supporters of both Hezbollah and Hamas against the Israelis, and the USA and the rest of the West are standing firmly behind Israel. And so there is a real potential that this conflict could flare up into something much larger, and if it does, that will have a major negative impact on the global economy. So in terms of the outlook for the next couple of months, it's really uncertain and unstable. We don't know what's going to happen with those two conflicts. We don't know what's going to happen with global oil prices, which always have a really big influence on what's happening with the economies around the world. And so there's a really big question mark as to whether China will be able to hit its growth in November and December. And if it doesn't, it will miss that 5% target, which will have a negative impact on the Chinese economy. But as I mentioned right at the start of the video, China is the second largest economy in the world. So if China misses its target, it's likely to have a knock-on impact to everybody else, and therefore will add more problems to the global slowdown and potentially push more countries into recession during the first half of 2024. So as we've discussed, the Purchasing Managers Index is the first piece of data that we get every single month. There will be more data coming out over the course of the next week or so. We'll get an update on what's happened to exports and imports in the month of October, and those figures will be critical to give us a really good steer as to what will happen over the rest of this quarter. So I'll keep you posted as soon as that news is released. Hopefully you found today's video useful, informative and thought-provoking. If you've liked what I said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.